In March 2020, global financial momentum simply froze. Equities crashed, and market volatility spiked as the global economy entered a period of severe paralysis. Institutional and retail investors reacted immediately, pulling capital from risk assets and retreating into traditional safe haven commodities like gold to protect their liquidity. Yet, amid this massive reallocation of capital, an unexpected anomaly emerged. An alternative asset class composed entirely of tangible consumer goods generated a yield that doubled traditional equity returns during the exact same crisis window. This chart compares the exact annualized nominal returns of these assets. Gold provided a 12.2% return, and the Nifty 50 index delivered 15.7%. Luxury watches returned 30.6%. Furthermore, this massive outperformance occurred exactly when traditional equity markets experienced their most volatile drop. To understand this yield, we rely on a dataset composed of highly curated portfolios held by 57 high-net-worth individuals in India's financial capital, Mumbai. The physical scale of this asset pool encompasses 464 elite luxury timepieces. According to the data, 65% of these specific purchases were deployed as calculated investment opportunities, directly countering the idea that high-end watches are strictly vanity items. This 30.6% yield suggests a logic beyond simple retail trends, a result of specific structural interactions between supply, currency, and demand. To accurately map how this yield was generated, we have to evaluate these physical collectibles as highly reactive financial instruments. First, we have to prove mathematically that this return profile represents a genuine structural advantage, rather than random market noise. This normal distribution curve illustrates a right-tailed Z-test. Against a 99% confidence level, the critical rejection region begins at a 2.33 Z-score. Tested against the Nifty 50, portfolios yield 2.94, breaching the boundary. Against gold, it travels further, landing at 3.63. Rejecting both null hypotheses confirms categorically that the watch portfolios outperformed the foundational benchmarks of the financial system. This degree of mathematical certainty forces portfolio managers to question the underlying architecture of the asset class. Because the statistical proof is undeniable, we must perform an autopsy on the macroeconomic forces that created the exact conditions for this yield. On the global supply side, the mechanics begin and end in Switzerland, the undisputed monopoly exporter of high horology. The primary macro catalyst for this anomaly was the rapid and sustained appreciation of the Swiss franc during the pandemic. This chart tracks that appreciation. The Swiss franc strengthened continuously against the world's major watch-buying currencies, specifically the US dollar, the Hong Kong dollar, and the Indian rupee. This currency appreciation made Swiss exports significantly more expensive at the exact moment production halted. An aggressively expensive base currency collided with completely halted manufacturing, resulting in an immediate, extreme supply deficit. Authorized dealers were completely drained of inventory, triggering a collapse of the primary acquisition market. Without primary inventory, all global demand was forced to reroute into digital, unregulated secondary market platforms. Concurrently, high-net-worth individuals experienced a surge in trapped disposable income as their pandemic travel and luxury expenditures fell sharply. This highly capitalized, inelastic demand slammed into the heavily constrained secondary market, driving massive price premiums on the few available pieces. Luxury watches inadvertently acted as a synthetic hedge against fiat depreciation. A global supply chain failure was converted directly into unprecedented investor alpha. Pivoting from global macro trends down to the micro-portfolio composition of the Mumbai dataset, we see exactly where this alpha was generated. Horological alpha is not distributed equally across all luxury brands. Accessing this yield requires extreme curation. Returns are heavily concentrated in the big three elite Swiss brands. Standard luxury tiers do not provide the same hedge. Within this specific dataset, Patek Philippe operates as the absolute apex performer. Patek Philippe delivered a 5.01% monthly return, compounding into a 59.1% annualized nominal return. Applying a horizontal threshold line for India's 7.6% peak pandemic inflation, both Patek Philippe and Rolex completely eclipse this inflation drag. But this brings up the primary institutional objection to physical assets, the danger of severe illiquidity during a market panic. The data shows that out of 464 watches held during the worst of the crisis, the retention rate was a staggering 96.55%. The subjective emotional utility and the social status of the physical watch act as an organic lockup period, overriding the impulse to sell. By contrast, equities can be liquidated instantly on a digital terminal, an efficiency that actively exacerbates panic selling and volatility. The very traits making watches uninvestable by traditional institutional standards, illiquidity and subjective consumption value, are exactly what dampened volatility and secured the high yield. To maintain analytical rigor, we must address the severe friction points that prevent this asset class from replacing mainstream equities. The barrier to entry is immense. Obtaining these specific assets at prices that allow for yield requires massive initial capital deployment and deep, multi-year relationships with authorized dealers. The secondary market also suffers from severe valuation complexities. A specific watch's return is heavily dependent on highly subjective microfactors, including the presence of original paperwork, complete servicing history, and pristine physical condition. Because the secondary watch market is completely unregulated, the alpha is captured exclusively by those willing to absorb profound operational risk and illiquidity. This portfolio allocation chart illustrates the synthesis of the 30% yield: structural supply constraints meeting highly capitalized, emotionally locked-in demand. This empirical data challenges classical assumptions in modern portfolio theory, which routinely treats consumer goods as depreciating liabilities. In eras defined by fiat instability and highly fragile global supply chains, traditional paper safe havens may no longer be sufficient in isolation. Physical, high-barrier collectibles with extreme global scarcity offer mathematically proven diversification benefits. The data suggests that for the advanced investor, the elite luxury timepiece serves as a rigorous structural hedge against macroeconomic instability.